We're covering the housing market today, the biggest asset class in the world, with the Fed cutting rates aggressively by 50 basis points. People are wondering where mortgage rates are headed, where the housing market is headed. Are we going to get a shortage or an oversupply now? Are we going to get significant changes in the supply demand dynamic? Are people going to start selling soon? All these questions will be answered with our guest today, Briton Hill, managing partner of the Providence Capital Group, and we'll also be talking about his outlook on the stock markets. Welcome back to the show, Briton. It's been a while. Good to see you.
Yeah, David, thanks for having me back. It's always great to see you and to be on the show. Thank you.
Good to see you as always. Let's start by talking about the housing market, your area of specialty. Turn over to my screen now. This is from CNN. It says here, this article came out in the summer. So, this happened before the Fed rate cut, but the housing market is stuck until at least 2026, Bank of America warns. And what they mean by stuck is they said the bank said home prices will stay high and go even higher. The housing shortage will persist and mortgage rates may not fall much. Even the Fed finally delivers long-delayed interest rate cuts, which they have. This will take many years to work itself out. There is no magic fix. Head of U.S. economics at the Bank of America told CNN in a phone interview, the message for first-time home buyers is one of patience and frustration. So he's saying not much change. Let's go over some of the assumptions here. The shortage will persist. Let's talk about that first. Housing shortage, what is he referring to? Will it persist?
Yeah, what he's referring to, David, is there's an extreme lack of inventory across the board right now. You have homeowners that are locked into their homes at low interest rates. They don't want to sell and have to buy a new home at a high interest rate. And then you have construction builders and builders, people who would do new construction, who can't get lines of credit from banks right now because banks are sitting on billions of dollars in losses. So the natural remedy to a housing shortage is obviously to build more houses. But we're in an environment where home builders can't get capital to build more houses. And it's just created this vacuum in this whirlpool where inventory is low and it's going to be tight for probably, I agree with Bank of America, a couple more years to come. And I think that we're going to see higher home prices as a result, unfortunately. But yeah, we have an extreme housing affordability crisis right now.
To your point, the U.S. is now short 4.5 million homes as the housing deficit grows. Despite a pandemic construction boom, the U.S. housing shortage grew to 4.5 million homes in 2022. This came in, again, June of this summer. At its core, the housing market is driven by supply and demand. When the number of people who want a home increases faster, the number blah, blah, blah. Okay, we know that. What is going to incentivize home builders to start construction and renew housing construction? As I've shown you offline here, if you take a look at the Census Bureau, it's showing that construction permits are flat, completions are up, so pending projects have been completed, but new starts are down. What is going to incentivize this blue line, this thick blue line, starts to go back up?
Yep. At the end of the day, it's going to take liquidity being injected into the markets again. To reiterate, banks, and I just sent you a picture that you can throw up there, but it's some FDIC data showing that there are hundreds of billions of dollars in losses right now. I mean, the losses on bank balance sheets right now dwarf anything that we saw in 2008, 2009 during the great financial crisis. I mean, it's extreme what we're seeing as far as losses on bank balance sheets. And what that means is they're overextended. They can't lend money like they used to, which means they're not able to meet the demand for housing and the demand for capital. And it's going to push home prices higher, and it's just going to make it really difficult to get that blue line on that chart, David, to move back up. When bank balance sheets are out of whack, even if you have a solvent bank, they have to be cautious because people are going to be watching that. Depositors are going to be watching that. We still have echoes of the bank failures we saw earlier last year kind of rippling through the markets. And you have the financial regulators that are telling banks to be very conservative right now because they don't want to see those balance sheets go out of whack any more than they already are and cause people to have another bank run and cause a banking crisis across the U.S. So it's a tricky situation. And what we're seeing as a result in our business is a lot of these builders are turning to private lenders like ourselves. I mean, they're just going around the banks entirely. They pay a bit of a premium by going to a private lender, maybe a couple of points here and there. But at the end of the day, getting a deal done with high margins is better than no deal. And with where banks are at right now, it's really tough to get a deal done with a bank.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. Well, do you think interest rates coming down, especially from the Fed funds rate side, is going to help with some of this liquidity problem that you're talking about?
Yeah, I mean, it's certainly going to help. I think we're still a couple of years off from it really turning things around.
Let me put it to you this way. At what interest rate level approximately would you need to see before you can say, hey, people are starting to really snatch on the loans once more? Or perhaps it's just the banks not wanting to lend. I don't know what it is, but I'll let you comment on that.
Yeah, and that's the $1 million question. Do rates need to be 6%? We already hit 6% mortgage rates in the US and things haven't really improved. Do they need to be 5? Is the magic number 4? I think that's what the Fed is going to try to figure out here over the next 12 to 24 months as they continue on a hopeful rate cutting cycle. One potential headwind that we've seen to further rate cuts is since the Fed has cut interest rates over the last month, we've been inundated with hundreds of millions of dollars worth of loan requests. It's as if a tidal wave of people who are sitting on the sidelines for the last 2 years hoarding cash. And we know there's trillions of dollars of cash sitting on the sidelines in money markets. They're all of a sudden mobilizing their resources and they're trying to buy assets. They're trying to get loans. They're acquiring properties again. The benefit of that is it could push asset prices back up. Real estate prices are going to continue to appreciate. That can also be a downfall to people who are sitting on the sidelines. But the biggest thing I worry about is if there's hundreds of billions or maybe even trillions of dollars coming off the sidelines back into the real estate markets because of Fed interest rate cuts, that's going to cause interest rates to stay higher for much longer because that's going to contribute to more housing inflation and real estate inflation, which is a key driver of inflation in general. So I hope we don't see that. I could see it happening, and that could cause home prices to stagnate. We haven't seen that stagnation yet, but we're still too early in the rate cutting cycle to see, okay, what is the sweet spot? How is this going to improve things? And I think the Fed's going to have to go a lot slower than they think with how much cash there is on the sidelines.
Okay, so here is the mortgage rate. 30-year fixed rate in the U.S. is an average, obviously different. So this is an average from the St. Louis Fed. Like you said, it started to come down. It has already been coming down well before the Fed cut rates this year. It peaked around 2023. Generally speaking, though, it doesn't look like it's very well correlated with the Fed funds rate. As you can see here, if you just overlay this with the Fed funds rate dropped down to 0 in 2008, 2009, but mortgage rates stay high. It was slowly trickling down all throughout the last decade. In other words, the Fed funds rate dropped to 0 pretty much in the span of a couple of weeks, couple of months, but the mortgage rate stayed elevated for quite some time. Why is it that historically mortgage rates tend to be stickier upwards? In other words, even the Fed cuts, mortgage rates don't come down right away.
Yeah, it's a good question. A lot of people will mistakenly think that the Fed cutting short-term rates is going to have an impact on long-term rates. Oftentimes, interest rates do move in parallel. If short-term rates are coming down, long-term rates are usually coming down alongside it, and that's the long-term trend. But there will be periods in time, especially during potential recessionary cycles where people are unloading their bonds or having to liquidate assets. There will be periods in time where short-term rates could hit 0, but mortgage rates will remain high. And we've seen the mortgage rates come down. We're obviously now seeing the short-term interest rates come down. Short-term rates coming down isn't a guarantee that mortgage rates are going to come down. That's going to be largely dictated by the market, which includes how banks are behaving. Are the banks lending? How much capital there is out there? If there's capital constraints still, well, that's just going to cause lenders to charge a premium for cash, which is going to push interest rates higher. So yeah, that's another thing to consider here. The Fed is cutting short-term rates, But is that going to have an impact, an immediate impact on the longer term mortgage rates and long bond rates and those types of things? I think it will, but I don't think they'll move in parallel on the short term or the midterm basis.
Based on the conversations you've been having with your partners and associates and clients, is it a buyer's or seller's market right now for residential real estate? And I ask this because a couple of years ago, it was interesting because while mortgage rates were going up, people held on to their homes. We expected homes to sell off, but that wasn't the case because people didn't want to refinance at much higher rates, right? So ironically, I guess that was not, a buyer's market when rates were rising. What's going on now?
Yeah. I know the answer always usually is it depends on where you're at, but it depends on where you're at more so than it ever really has. I mean, I live in Logan, Utah area, so northern Utah. Prices here have slowed down dramatically, price increases. And, in my neighborhood alone, they've pretty much flatlined right now, where we haven't seen any price increases. But you go into other areas of Utah and it's rising dramatically, or areas like Boise, Idaho, where you're getting 7 to 10% jumps year over year, which is far exceeds the median of about 4 to 6, depending on where you're at. So it depends on where you're at. Right now in northern Utah, as an example, it's definitely a buyer's market. Buyers have a lot more room to negotiate. Sellers are offering concessions and rate buy downs and all sorts of things. In a place like Idaho, where we do a lot of our lending activity and a lot of our development, you have Micron, Meta, Microsoft, all the big tech companies are building multi-billion-dollar data centers and facilities in the area, and they're bringing in thousands of employees from California, New York, all of these tech areas that are very expensive. And these executives are now moving to Boise, Idaho, and $1 million buys you a 5,000 square foot house on 5 acres with a pool, where $1 million in the Bay Area gets you a condo. And so inventory is just being snatched up, and for a premium. Anything that gets listed in an area like Boise immediately sells. And there's an extreme need for capital and bank lending up there, but it's more of a rural suburban city. It's kind of out here in the boonies. It's overlooked by a lot of these big capital providers and these big banks who are based largely on the coasts and in big cities. So you have these underserved markets where it's really hard to get large bank lines of credit in. They're overlooked because they're smaller cities, but there's an extreme amount of growth, and it's just creating the perfect storm of rapid price appreciation, low inventory, and a really long runway to get that inventory ramped up.
What kinds of people are you lending to right now? What is their profile? What are they looking for?
Yeah, we're lending to mid-sized builders mostly. So builders who are doing anywhere from 5 million to 50 million a year in revenue and building. And these are the guys that got hit the hardest from the banks. They're guys that had relationships with regional banks and community banks. And a lot of these banks now are capping out their lending to 10 million per guarantor. And 10 million per guarantor means 10 million to the signer on the loan. And so you have these guys who are used to doing 50 million a year in building that are now only able to do 10 million a year. So they just lost 80% of their business because their bank isn't lending them the money. Fortunately, a lot of private lenders are kind of entering the space. You've got large family offices like the Bezos family office, as an example, who's entering private lending. We're a private lender. And so what these builders are doing is they're just turning to the private lending markets.
What is the reluctance from the bank right now? And we come back to this issue, but it sounds to me like there's a reluctance from the banks to lend, or maybe these profiles of builders is no longer meeting the criteria for lending. I don't know what's going on. Can you comment?
Yeah, they've just had to get a lot more conservative. If you have a few $1 billion of bad loans on your book, you have to balance that out by doing some extremely good and extremely conservative loans, which means that your borrowers are having to bring an extreme amount of cash to the closing table. The only problem with that is we're in a liquidity tight environment where most people aren't sitting on overloads of cash right now. And so it's really difficult for the banks to balance out their balance sheets right now with really conservative loans. We're talking lending 40 to 60 cents on the dollar. That's hard. It's 80 cents on the dollar is where most banks are going to be getting hit for loan requests. So it's just challenging right now with where bank balance sheets are, and them sitting on those losses. They need time to absorb them or to offload them, or just for the market to turn around and get enough capital appreciation of the underlying collateral that they're back in a solvent state.
Yeah, so I've read, and you've corroborated this. I've read that construction spending and also just starts has stagnated or slowed down since the pandemic. I wonder if the lumber price had anything to do with the construction slowdown here. This is a lumber price spiked during the pandemic. It's normalized now. Was this a contributing factor at all? I think the input prices were just way too expensive for builders for a time.
Yeah, you can call it a contributing factor. You can call it a leading indicator, or something to look at. I mean, the beautiful thing about lumber in particular is it's the base material for building in most of these areas. And so when you see lumber prices going through the roof, that indicates an extreme amount of demand. And, demand, when there's high demand and low supply, that's price appreciation. And when those prices are plummeting, you're seeing that demand has fallen off considerably. And the demand for lumber has fallen off considerably for a variety of reasons. One, on the consumer side, you have really high interest rates, which are pushing people to wait and to hold their homes, and they're not buying as many new homes. But on the building side, you have a lack of capital to start building new homes. I mean, if a builder can't get a bank loan, he certainly can't pay for a lumber package. And as a result, lumber prices have come down.
Okay, this is another stat that came out this week. Earlier this week, construction spending data came out. So construction spending fell in August. This is last month's data reported this week as companies scaled back projects across the U.S. ahead of a Fed Fund's decision to cut its benchmark interest rate. Now, we'll see what happens next month. We'll see if the spending data ticks up in light of this 50 basis point cut. But apparently what happened last month is residential real estate, private residential construction spending fell 0.3% in August. Spending on single family construction fell 1.5%, and spending on multifamily construction fell by 0.4%. In this industry, are these significant numbers, or is this just a normal trend following the summer?
It's a normal trend. Towards the end of the summer, especially, you just have builders, they're actually completing projects. And in the Mountain West, especially, where the ground freezes in the wintertime, it's really hard to get that horizontal construction done, which is your utilities and roads for the most part. So you have builders that they'll wrap up their projects at the end of the summer, and they'll kind of just wait until the spring in these areas until the ground thaws out, and then they can actually hit the ground running. Otherwise, they're sitting on projects that they borrowed money for, and money's expensive right now. And they're just paying interest on an asset that they can't even really operate or start working on. So it's cyclical. If you look at the year over year, spending is still up 4.6%. I don't think 1 to 2 months of data showing price decreases is anything to worry about. I think that there are still builders who want to build. We're certainly seeing a lot of demand, and the biggest issue is getting cash in their hands to do it.
Let us take a look at campaign issues. So this housing affordability has become an election issue. A standout campaign issue for the 2024 presidential election has been housing affordability, USA Today reports. Amid a housing market with rising rents and home buying out of reach for many Americans, both Democratic presidential nominees have vowed to make housing more affordable. I'm just going to comment on the Harris side for now. Her solution is to build 3 million more homes over 4 years. I haven't looked into the details. I don't know if there are more details, but what kinds of homes would they be? How would the government even do this?
I don't know. I mean, I certainly think that 3 million homes could be built over 4 years. Really, what it's going to come down to is getting capital in the hands of developers. So,
but when the government says they're going to build 3 million homes, are they going to contract private contractors to do this on the government's behalf? Are they just going to provide more liquidity? Are they just going to encourage the private sector to do it? What does this actually mean?
Yeah, it's a good question. It kind of remains to be seen. That a lot of politicians say a lot of things, and it's up to them to deliver on it or to decide how they want to deliver on that. But if we can go back to the 70s and 80s, what they did during those times when rates were really high and inventory was low was offer incentives for people to buy homes. So whether that was through tax breaks or special loan programs, I could see them doing something like that. I think the biggest issue now is we need special loan programs because our banking system is still working out. its problems. And so we're not going to get money for the banks. But if there were grant pools or other forms of capital that could get out there in the hands of these builders, I mean, you could certainly get 3 million homes built. There's no doubt in my mind. It really just comes down to getting cash in the hands of the builders.
So this is actually in line with what you're saying. So Harris, her proposal includes up to $25,000 in down payment support for first-time home buyers. Um, this would provide working families who have paid their rent on time for 2 years and are buying their first home up to $25,000 in down payment assistance with more generous support for first-generation home buyers. This comes in the form of perhaps a tax credit. Yeah, home builders, $25,000 in down payment assistance for 400,000 first generation home buyers or home buyers whose parents don't own a home, and a $10,000 tax credit for first time home buyers. So is this going to help with the 3 million units? Are home builders going to look at this and say, "Wow, there's going to be much more demand. We need to speed things up"?
It certainly solves one side of the equation. And that's the buyers being constrained. It's going to help a lot of people be able to financially push things across the finish line. It doesn't solve the inventory problem, though. And that's what I think the root of this entire issue is here, is we just have really low inventory. And, I think we talked about this on our interview over a year ago, David, how these types of things would happen, and we would see subsidies come up and special benefits and interest rate buy down programs to help people get into their homes. And we're starting to see proposals. I think it's only a matter of time before they actually start implementing some of these policies to help home buyers out. But they also need to focus on the builder side so that builders can produce new homes to meet the demand and to fill that capacity.
You have affordability being solved by tax credits, $25,000 assistance. In theory, that could help, but I'm just going to play devil's advocate to her plan here. If you were selling your home and if you own many properties, would you not just raise the price by $25,000 if everyone's getting free money by the order of $25,000?
And you would, at the end of the day, during the 1970s and 80s, home prices rose an averaged annualized rate of about 11% per year. And that was when interest rates were far higher than what they are now. And that was a result of a lot of these programs. So these programs are designed to help stabilize the housing market. The end result of them is they tend to push house prices higher. I hate to say that. I mean, it's terrible how expensive homes are right now. People are already getting ripped off, but we have a housing affordability crisis. I think rates can go down. That'll ease the burden on borrowers. But at the end of the day, these programs provide more money to more people. And we've seen what giving trillions of dollars to people does to the overall inflationary picture, but through all the stimulus package that happened during the pandemic. So, yeah, I do think that we're going to see home prices rise, and maybe even rise faster than we would normally see them rise if they start implementing these types of programs, because it's more money in people's hands to buy homes.
Interesting. So the affordability program would actually be, per your theory, counterproductive.
Yeah, if we're looking for lower home prices, I certainly think it'll be counterproductive.
I was going to ask you if these affordability campaign objectives are going to make housing more of a bearish asset for you if you were investing in it. But from what I'm hearing, practice is different from theory.
Yeah, I mean, just based on what we've seen in the past, eventually things will top out. But housing market crashes are few and far between, and they're pretty rare. I think it would be it would have to be a combination of things. It'd have to be a combination of really high interest rates. All of a sudden, a ton of inventory hits the markets, and buyers just don't want to move off the sidelines or new buyers aren't purchasing homes to really see a market crash. Otherwise, housing is relatively resilient, and the federal government does everything they possibly can to preserve that housing, at least in the U.S. I mean, that's kind of the American dream right there. They really try to do everything they can to stabilize the housing market, because that's where so many Americans have the bulk of their net worth is tied up in their house. So I wouldn't necessarily shy away from buying real estate right now. I think that the market fundamentals are setting up good. but you have to be careful on where you're at. And you want to be in those places where there truly is a shortage of inventory and a lot of demand of people trying to go in there. So follow the cranes. If you look at the Boise skyline, especially in the southeastern portion of Boise, you just see hundreds of cranes everywhere. They're building, all the businesses are moving there. So areas
Wait,
like that.
what would cranes signal bullish or bearish momentum? Because if you're seeing a lot of cranes, that means a lot of building. That means more supply, right? Wouldn't that be bad if you're an investor?
Yeah,
Or no?
I think it depends. For us, the
Okay.
cranes are showing industrial building. So the
Oh, I see.
Micron's building a $15 billion plant. And so that is going to produce thousands of jobs, which means, and a lot of those jobs are going to have to come from out of Boise because Boise just doesn't have that capacity internally. So that's going to create more demanding for housing there.
Do you, again, I know this depends on the area, but just based on what you've seen, are people building more single family homes or condos or townhouses or multifamily homes? What's the priority right now for
We've
builders?
seen a lot of demand on townhomes right now. That's where
Hmm.
we've had a lot of our loan requests come in. A lot of our success, and our most successful borrowers have been doing the townhomes. And these were formerly single family home buyers who have now had to cut their standard of living in order to be able to afford their own home. And it's a townhome now. So yeah, we're seeing less single families move, more townhomes lately.
Interesting. All right. Well, you were bullish on the stock markets last year. I think people laughed at you. You turned out to be right. What's your outlook now? How do you feel?
Man, yeah, that was tough to be on that side of the fence last year, but I don't blame people for thinking I was a nut. You know, back to back 20% years is tough to sustain. And I think we're finally starting to see things slow down and kind of take a breather. This is entirely normal. I wouldn't be surprised if we even saw a 10 to 15% pullback from here. So what I would advise people is if you were one of the few who decided to buy in and have been holding stock positions over the last year, and you're feeling like you're a little top heavy, lighten up, purchase some yield bearing assets, whether it's a private credit fund, that just delivers yield, or a REIT or a real estate fund, or even, money markets and bonds, things like that. Just kind of de-risk yourself and diversify. We could, and it would be abnormal for another 20% rally to happen. More abnormal than it would be to see a period of stagnation or a contraction. For those who are sitting on a lot of cash and don't have any stock exposure, this might be a good buying opportunity, noting that we could see a pullback, but the consolidation periods are also great times to buy.
It's interesting because the rally happened in the last year and a half on the back of higher Fed funds rates. And I think at a certain point all throughout this year, the market was pricing in lower rates, and they finally got that. Now that we're starting to see a Fed easing cycle, I wonder if the markets are going to start pricing that out. In other words, we've already seen what's priced in. Is this the top? Is kind of what I'm wondering.
Yeah, I mean, it certainly could be the top for now. The only guarantee I can make is we will have another bear market, whether that's tomorrow, a month from now, or 5 years from now. I mean, it's inevitable. That's why, a long-term buy and hold strategy is usually the best. I do agree with you that a rate decrease was priced in and has been priced in all year. I mean, it was inevitable with where the Fed funds rate was at and how aggressive they were on increasing rates. We knew that a rate decrease was looming, and that's probably partially what kept the U.S. economy afloat and kept the stocks on their march upward. One thing to point out, though, is a lot of the stock market performance has been driven by a few names, and a few really big names like NVIDIA as a prime example. You have outliers who have done extraordinarily well, where if you look at the Russell 2000 and more of the small cap names, they haven't performed near as well as the large caps. And so if you have smaller and mid-sized businesses that are struggling, those businesses will tend to benefit greatly from rate reductions because they can get cheaper capital and help shore up their balance sheets. So we could actually make the argument that, hey, these lower interest rates are actually going to benefit the smaller cap companies, which are going to push small caps and mid-sized caps higher. I could see large caps slowing down though. They've been aggressive.
Any specific sector you feel like has the best value right now?
No, for my stock holdings, I'm very, very broad. I have index funds that just cover small caps and mid caps and large caps. it's really hard to pick a sector right now where rates are high, and you've got just so much going on. Semiconductors have been great, obviously, with the whole AI boom, but I think we're starting to see premiums added to those that are justifying pulling back and pulling out of those. But um, I like real estate. I like consumer goods, things like that. If I had to really kind of dive down into the sectors, consumer staples, tech, and I know tech has been on a tear, but the reason I like tech related businesses is because they don't rely heavily on expensive money to operate their businesses. You know, they don't have to buy lines of credit to fund billions of dollars in inventory. And so they save a lot on high interest rate costs. They're a little less interest rate sensitive because of their lack of a need to borrow money. So
I've heard a theory that a lot of these companies that held a lot of cash or cash equivalents collecting short-term interest rates, now these interest rates might come down, and so their interest income may actually go down, whereas in the last year they've been soaring. I wonder if this is going to change the net profit at all significantly, and influence their capex cycle next year.
yeah,
In other
certainly.
words,
Yeah, I
interest
mean,
rates going down could actually be restrictive.
yeah, you could see it. I mean, I think prime example is Berkshire Hathaway. I don't even know how many hundreds of billions of
Sure.
short-term interest-bearing securities they have at this point in time. But I mean, a half point decrease in a money market when you're talking hundreds of billions of dollars, that's considerable. And yeah, it could affect the bottom lines of these companies that have a lot of cash. On the flip side, if their lines of credit become cheaper, it could actually benefit them more because chances are they probably have more debt than they do cash in most cases, and so it could end up helping them in that regard.
Good. Thank you very much, Britton. Where can we learn from you? Follow your work.
ProvidenceCapitalGroup.com is where you can reach me. I'm also on LinkedIn. Feel free to follow me there. Shoot me any messages. We're rebuilding our site right now, so if it's down, try again the next day, and it'll be up. And we're getting some good stuff put up there with some pictures of our projects that we're funding and everything.
Okay. So if you're interested, check him out. Links down below. Thank you very much, Britton.
Awesome. Thanks, David. Have a great day.
You too. And thank you for watching. Don't forget to like and subscribe.